Every modern economy depends on one invisible force: liquidity.
Liquidity is the ability for money to move freely through markets.
When liquidity flows smoothly, banks lend and markets function normally.
But when liquidity disappears, financial markets can freeze quickly.
In the United States, one institution manages this critical flow. This institution is known as the Federal Reserve.
The Federal Reserve is the central bank of the United States.
Między dobowy egzekwowania sprawy sempre na tercela.
Its policies influence banks, markets, and the entire economy.
At its core, the Fed manages liquidity in the financial system.
Because liquidity determines how money moves through the economy.
In finance, liquidity means how easily money can circulate. When liquidity is high, banks are willing to lend.
And when banks lend, businesses gain access to capital. That capital fuels investment, hiring, and economic growth. But without liquidity, the entire system begins to slow. To control liquidity, the Federal Reserve relies on powerful policy tools.
One of the most important tools is interest rate policy.
Interest rates determine how expensive it is to borrow money.
When rates fall, borrowing becomes easier across the economy.
And easier borrowing increases liquidity throughout the financial system.
But interest rates are only one part of the system.
The Federal Reserve also conducts open market operations.
This means buying and selling U.S. government securities.
When the Fed buys bonds, it injects money into banks.
That new money increases reserves and expands liquidity.
When bank reserves increase, the financial system gains liquidity.
More reserves allow banks to expand lending activity.
The financing came through, so we're set for the merger. It's a pleasure doing business with you.
But the Federal Reserve can also reverse this process. By selling securities, the Fed removes liquidity from the system. When liquidity declines, financial conditions begin to tighten.
Banks become more cautious about lending money.
This balance between liquidity and stability is crucial.
In times of crisis, liquidity can vanish almost overnight.
When panic spreads, banks may stop trusting each other. This
is when the Federal Reserve must intervene. The central bank can inject liquidity to stabilize markets.
These actions help restore confidence across the financial system.
During severe crises, the Fed may deploy extraordinary measures.
One of these measures is called quantitative easing.
Quantitative easing involves large-scale asset purchases.
The Fed buys government bonds and mortgage-backed securities.
These purchases inject massive liquidity into financial markets. With more liquidity, financial markets begin to stabilize.
Investors regain confidence as liquidity returns.
But excessive liquidity can also create new risks.
Too much liquidity may inflate bubbles in financial markets. When liquidity expands too quickly, inflation pressures can rise.
At that point, the Federal Reserve must tighten policy.
Tightening policy reduces liquidity across financial markets.
This process is known as quantitative tightening.
Federal Reserve decisions influence markets far beyond America.
This is because the US dollar dominates global finance.
So changes in liquidity ripple through global markets. Capital flows shift whenever Federal Reserve policy changes. Investors across the world monitor Federal Reserve decisions closely. Stock markets often react immediately to liquidity signals. Bond yields shift as investors adjust to new policy expectations. Currency markets also respond to liquidity conditions.
In this way, liquidity decisions shape global financial stability.
Yet the Federal Reserve must constantly balance competing risks.
Too little liquidity can slow economic growth. But too much liquidity can destabilize financial markets. So the central bank constantly adjusts monetary conditions.
Each decision aims to keep the financial system stable.
Or duly stimulus lolises. Liquidity is the lifeblood of the modern financial system.
And the Federal Reserve controls how that lifeblood flows.
Through interest rates, asset purchases, and monetary policy.
We need to finalize the Q3 reports by noon. The market volatility is unprecedented, but the underlying assets are strong.
Understanding liquidity means understanding modern finance.